Are you one of the many busy professionals working in offices day in and day out? Do you wonder how some people grow their wealth fast, retire early, and play on workdays? Well, you're in luck, because Ginny Bolling hosts this show, Pivot to Prosperity, where she interviews people that can do just that. Play on workdays. Many guests have become financially free. She also interviews people that are on their journey and people that are in support roles, like attorneys, contractors, brokers, and others. Commercial real estate is the common element. She is on a mission to be sure busy professionals know they can own substantial commercial properties too, like apartments, self-storage facilities, and others, and not have to do the work managing them. Passive investing is the key. Syndications are the typical method. Tax write-offs are some of the biggest rewards. Ginny and partners find the deals, build a strong team and business plan, then offer the investment opportunities to passive investors. New episodes are released every Tuesday at 12, so watch for new releases. If you want to get involved, let us know. You need to get pre-qualified to hear about most deals. See the show notes for contact information.
Hello. Ginny Bolling here with Pivot to Prosperity, brought to you by Pivotal Real Estate Investments, where we help our investors build wealth and income through commercial real estate that improves communities. And today we have Kevin Chow with us. Thank you, Kevin, for coming on.
Thank you for having me.
We usually talk a little beforehand, and so I want to turn it over to you to do your introduction and tell a little about your journey into real estate, and a little in that journey, hit some of those high points. You've got an impressive background. You should tell a little bit about that stuff, really. Okay.
Yeah, so I've had quite an interesting career journey. I graduated in 2008 with an economics degree from Yale. And 2008, as you probably know, was probably the worst time to graduate. It was in the middle of the GFC. I wanted to go into investment banking or hedge funds, but all those jobs were gone. So I ended up coming back to where I grew up, which is Dallas. Spent a little bit of time working for an oil and gas company, which is totally outside of what I was intending on doing. After about half a year, I ended up being recruited by JP Morgan to work in the private bank, where I spent about 3 years at the bank. I enjoyed my experience at JP Morgan, but I always envisioned myself as being more of an entrepreneur. So after I left the bank, I ended up doing a couple of small ventures myself. Uh, One of the businesses I built was in the high-end ultra luxury space. We started somewhere around 2015, 2016 when e-commerce was getting quite popular, obviously with like Amazon and eBay, but the idea of buying extremely wealthy things. Now, there were other companies that were doing luxury consignment. And so at that time, there were companies that were in the luxury consignment space. There were companies in the flash sale. I think you guys probably remember that time where like there was like those flash sales and all. But we saw a niche in kind of being an online concierge service where we worked on building relationships with um, watch dealers, high-end handbag dealers, jewelry dealers, and being kind of their online showcase and marketplace for them, and really bringing them to clients. And so we were regularly selling items that were 10 to several $100,000 and all to clients that and you had to build trust. So that you had to build trust with a lot of these clients because they didn't know if you're going to deliver the goods to them at all. And so we spent a lot of time building a relationship with them. We had a lot of clients that were royal family members from the Middle East. There were celebrities, um, billionaires. We we had a lot of them. And the interesting thing that we learned from that business was that many of them act as any other normal person. So we had very wealthy families, and we would just be chitting chat with them and all. Some of them are extremely well known on a first name basis, but they would just come to us and be like, "Hey, Kevin, we're looking for this and all. Could you help source us this?" So I would say we spent many years building this business up. Um, And eventually, when COVID hit, the business did take a hit due to a lot of the supply chain issues, a lot of the luxury goods, as you probably knew, their prices went through the roof. And so we had difficulty sourcing it for the cost that we wanted to source this. So, but at the same time, we pivoted and built some other businesses, one being like in the online education business. Now, online education, right when COVID hit, started growing very quickly, and we built a business on that, um, which was something that we continue to run in the background. And around 2020, I took the capital that I made from these businesses and started investing into real estate as an LP and joined a mentorship. And I think these mentorships were kind of a great way for me to get the education in, learn what I needed to about the business. But what I really recognized is that if you wanted to get good at this, you really need to focus on your strengths, and that's something that I always say: focus on what you're good at, and partner up with those that are good in an area that you're not good at. Um, so I knew from the get-go that I didn't want to deal with the operations of an asset, and simply because it it was like buying a new job, to be honest. It was getting yourself a new job, and unfortunately, I think a lot of people go into managing a property and they don't realize the amount of work involved, especially if the property has a lot of moving parts. When you're like value add, um, I hate to say it has a lot of moving parts because you're dealing with challenging debt, you're dealing with perhaps GCs, value add projects, you're dealing with delinquencies, you're dealing with turnovers, you're dealing with the property management. So there's a lot of parts moving, and I said to myself, "Hey, that's not my side, but what I am good at is working with investors or raising money because I had raised money for my own companies. So I raised money from companies, and frankly, I had a Rolodex from my business of extremely wealthy people. So I actually started off raising by going back to some of my clients from my other business. Now, that was just very, very lucky, but I felt I had an advantage doing so because I had spent many years learning how to cultivate relationships with high net worths. And then now raising money is all about building relationships with them. So over time, um, the thing that I think is very important in my business was finding the right people to partner up with. And I can't stress the importance of building very exclusive relationship. I've been involved in 15 projects, I think 15 or 16 projects as an LP and GP. So, and many of them are with different uh, partners or sponsors. But over time, as I tried each of them out and figured out who was the right one to work with, I've eventually gravitated towards working alongside exclusively a partner. Um, and that's extreme and that's very important. And the thing I would say is very important in a partnership is that it's a two-way street when it comes to partnerships. And oftentimes that's not a case, especially if you end up partnering with someone that has a lot more experience than you. You have to be able to bring something to the table. And I had, by that time when I started partnering with this group that now I exclusively work deal, I had raised quite a bit of money. I think at that point I probably raised 10, 15 million at that point before I started approaching them and building a relationship with them. Um, and so they knew I had the capability of bringing in good capital, that I had the kind of the relationships, and that I could bring them value. Um, and they had been established for several decades and all. And I feel that if I was not able to bring something to them, they probably would not have included me in what they're doing. So I think one of the things that I think is extremely important is building relationships and knowing exactly what your strengths are and how that strengths can be brought to the table and always be looking for a good partner to work with. So I think I kind of talked a lot, but maybe let you ask some questions.
I think that's great though, to, that's a key thing in our business, as you know, to be able to partner with the right people. And we see it all the time. Like there's so much stress in the market now, and you really find out what your partner's like when you're under
Hmm.
stress, right? And
Hmm.
some of those partnerships are breaking apart. And so, yeah, good case in point. But anyway, so now you are into lending then, right? So tell how that looks.
Yes, yeah. So we have gravitated towards being a kind of like a private equity financing sponsor. And what that means is that we try to be the check writer or the into projects and not be the actual operator. So we find and we build long-term relationships with developers and operators and all. And we kind of follow them. Sometimes it takes us many years before we'll invest into one thing with them, but we're always building long-term relationship. Um, the partner that I work with, one of the great advantages is that they they've been in real estate for 30 plus years, but before they uh, became this financing we call financing sponsor, they actually built their business as a broker. And so they're leveraging their brokerage business to receive tons and tons of deal flow. Um, and with all that deal flow allows them to really kind of pick and choose what is the right project that kind of fits their mandate, that fits what they have. And when you're able to choose, I would say last year we saw probably upwards of 500 different projects. When you're able to look at that many, then you can really kind of not only pick and choose the ones, but you can also decide which ones you invest in and invest with the terms that you want to invest in. In today's market, it's very challenging. So um, I think the saying goes like he who has the money makes he who has the gold makes the rules. And so in a challenging market like this, we have found that we're able to negotiate terms that um, are probably unheard of and probably would not be negotiable if the market wasn't the way it is right now. And so we like being in this position because we get to leverage the boots on the ground and the sponsors that have market specific knowledge. So what that means is that we typically work with different operators in different cities. And we try to work with operators that have almost exclusive experience in that one market. Because nowadays, what you're seeing is that you've got a lot of operators that are kind of scattered all around the country. They're doing one deal here in the city, and then they're doing another deal in this city. And so that can be an issue because a lot of times that sponsor doesn't have boots on the ground in something they're investing in. So in our case, we look for sponsors that have a foothold in a certain MSA. Just as an example, we work with one of the largest developers in Florida. They have spent 30 years developing somewhere over 9,000 units in South Florida only. So we can feel comfortable that they understand a lot of the cost that's necessary, the exit values, the sales, the rent prices, and the strategy in going after that market. And same thing in New York, we have a totally different operator that we've negotiated and we've done programmatic deals with. Because they spent the whole career just building in that market. So we're able to leverage those market specific knowledge and all. And that's really the key thing because as a financing sponsor, you're not really there to be babysitting and checking on day to day of everything and all. You're really only there to kind of make sure everything's on track and that the developer, but we trust them and you really can feel that you can trust them to execute and do what they're doing, which allows us to be able to focus most of our time doing two things: building more relationships with more operators like that and bring in the capital needed to back these projects.
And that's the critical part, right?
Hmm.
So, yeah, and you had talked with me a bit about the structure piece of it. Do you think that whenever there's trying times, that's usually when some new things come out. Is
Mhm.
there anything that you're seeing as a new trend or new opportunity or option for that matter that you think is going to be like up and comer thing that we'll see more and more?
Well, I know we talked about it before this about how we have focused a lot of our investments in the private credit and preferred equity space. So one thing that we're seeing a lot of, especially on the institutional level, is that a lot of the larger capital is trying to move up the capital stack and invest higher up on the capital stack. So everyone's moving into senior debt, everyone's moving to pref equity, and everyone's moving into mezz. Common equity has been very, very challenging, but that's really where we're heading to. I think I read a couple of weeks ago that Goldman is spending a lot of money to build up their private credit division in their company. So um, I think a couple of years ago, I think most people had never heard of private credit, but believe it or not, private credit is a very, very large space. When we think of it, private money lending is in a way private credit and all. Um, and so just kind of give you an idea what is private credit. Private credit is really any kind of debt debt like structure that we can invest in. Now, we like to do preferred equity. Some people call it not like private credit, but you can structure it, and that's how we've done. We've structured in a way that it really kind of acts like debt. And what does that mean? Number one, um, most of the preferred equity that we do, we require some kind of hard pay pref. And what hard pay means is that we require some kind of payment to us. In a lot of cases, we not only do a hard pay on what's called a current pay. So the current pay is on a typical pref is what's getting paid out during the investment hold. And then there's something called the accrued pay, which usually gets accrued and paid out towards exit. So as an example, let's say the pref is uh, 14%. So oftentimes about half of it gets current pay, 7% gets paid current and all, and then the other 7% doesn't get paid out and gets accrued until exit. What we've done a lot of our deals is that not only is the current pay paid out, but we actually have that accrued portion paid out on an annual basis. Um, and again, as you mentioned, in a challenging time, you can negotiate things that doesn't almost it's non-market. Um, the way we're able to do it is that we usually um, I wouldn't say cross collateralize isn't the right term, but we have our partners sign essentially a payment guarantee, and all that's backed by other assets in their portfolio. And we underwrite those assets and we say, hey, we know you cash flow X amount of money. We want that cash flow to also support paying our pref and all. And if you have an operator developer with a large enough portfolio and all, we can essentially utilize that to get us paid, which is very nice because you're getting cash flow, like true cash flow every year, which is very much like that. And you're getting a very high amount. In our case, we're getting 15% plus split between that current and accrued pay. So getting good cash coming in, that's something that we know a lot of investors like. They want good cash flow. Um, and and in many of our cases, we even sign PGs on our pref, which, as you probably know, is like the golden ticket when it comes to real estate. It's very, very difficult to get those terms. Now, how
And
do we
let's
get these?
let's just define PG, personal guarantee.
Personal
Yeah.
guarantee, yeah. So personal guarantee is very rare to find in real estate, but we have built very strong relationships. And just to kind of let you know why a relationship is important, the story is that we helped that particular developer during COVID when everyone else was not deploying capital, but we deployed and helped him at a time when some of his assets were having some trouble due to moratoriums that a lot of states have. Everyone was like, we're not going to help you and all. We helped him out. And as a result, he said, you know what? You helped me out. I'm willing to sign on these terms that most people won't sign on to. So that's kind of how we've been able to build such a good relationship. And as you can see, again, like the thing I stress is all this whole business about relationships, who you're working with. And a lot of times if you scratch someone's back, they'll scratch your back.
Right. Yeah. Yeah. And that's so true. And it's nice when it should be that way, you would think, but sometimes it's not either. So
Yeah.
yeah, but so as far as people that might want to get involved in what you're doing, is there a way for them to get involved?
Yeah. Well, certainly I would say for people who just wants to kind of learn about what we're doing, I'm always happy to talk. I love meeting new investors and experienced investors. What I found out when we went to market with these preferred equity, and we were we were fortunate to do so quite early. I think as we started to see interest rates rise back in around 2022 and early 2023 was when we started deploying pref equity. We kind of said, you know what, it it's better to be the bank than to owe the bank. That's something I always say. It's like if a lot of times when you're the operator, your investor, you're at the mercy of the bank and all. And if interest rates change or you're having trouble, I mean, you're really at the mercy of someone else. But so by being the pref equity and being able to be higher up in the capital stack, which provides you a level of protection, um, and all, it allows you to also be able to be more protected on your investment. Um, and as I said, be the bank. So what I would say is like people who want to learn how to like know how to get involved and understand these type of structures. Um, it does take some time to learn about what pref equity, because most of the time that people, when you're in a syndication, most of the investments that you're typically doing is as an LP common equity. Okay. And as you know, there are obviously pros and cons for every kind of investment. Common equity, you are sitting at the bottom of the capital stack. It but you get all the returns if the property does well. Okay, so the property does well, you can certainly make very, very, very high returns. But in our opinion, over the last couple of years, we just haven't seen a lot of things hitting high returns. And so it made more sense to do something like a preferred equity structure where you may be capped on your returns, but if things don't go as well, you can have some kind of protection. So we like to be a little bit more conservative on the investment. Um, and so that's kind of why we do that. But kind of back to your question of like how people can get involved, I think I'm very open, and hopefully you can share my contact information if anyone wants to learn about like uh this kind of structure or how I built a business in raising capital and building relationships. I'm always happy to talk about that.
Okay. Um, and then to take the the perspective of the LP for a moment, which some of our listeners are, of course, one
Mhm.
of the things that that they may or may not be aware of, depending on how experienced they are, is how that payout order in the capital stack, how vital that is. And
Mhm.
you had said, I think it was before we were recording actually, that sometimes on your pref, or maybe it was after recording, half of it might be at that time and then half be accrued, right? As you go, and then half accrued. So that
Mhm.
as us, for us as GPs and LPs, that's a big piece because we want to be sure our LPs will also get some money too. So it's important for us to always look at what the GPs are agreeing to with
Hmm.
whoever they sign any terms with.
Hmm.
And so at times there is such a thing as a predatory lender,
Hmm.
right?
Hmm.
And so that's something I've seen in a couple instances where, I, for instance, had a chance to get involved and I just felt that it was too predatory. So I
Yep.
decided not to. Is there any kind of insights you can share with people on what to watch out for?
Yeah, I mean, I think certainly it's all relative when you consider what's predatory. Um, and at the end of the day, the GP, if they're taking in some kind of like preferred equity or whatever structure, um, they have to know what's market. Okay. And market means not only that particular market, but also that particular asset. We're able to charge a lot more than usual on our pref equity is because we like to deploy our capital in markets that a lot of people like to stay out of. So as an example, we do a lot in New York. A lot of people don't want to invest in New York at all. And so as a result, a lot of people, there's not a lot of capital or capital going to New York. I mean, there's capital going to New York, but a lot of retail like has been taught don't invest in New York. It's a blue state, not red. You got to stick in Sun Belt states and that type of stuff. But because of that, that actually gives you an advantage if you were to do this. So we're able to charge a lot more if we were to invest. That our pref would be much higher in a New York. If we were to do the same asset in Texas, it would be much lower. Okay. So people, if they were to see the numbers that we're giving to a New York sponsor, they must think it's predatory. But the thing we tell them is that it's not predatory um, if because again, it's up to the GP to make a decision and all on whether it makes sense for them.
Yeah.
And we like to build long-term relationships. Um, but at the same time, we're investors, so we also have to say what makes sense for us and our own investors, because our responsibility is more to our investors and obviously the borrower. So our
Well,
investors' money and how to protect them is the first thing that we have to do. And if someone says, "Hey, the rates are too high," then we either reassess and say, hey, does it make sense or not? Or we say, well, maybe that's not right. We have the risk has to be in line with it and all. So yeah.
that's the magic
Hmm.
right there, balancing the risk and that
Yes.
profile. But the
Hmm.
overriding key to that is,
Hmm.
do you value the relationship? Are you building a
Yes.
relationship or are you just trying to get property? Right?
Yep, that is correct. I mean, we've done with this New York developer that we've worked programmatically, we've already done 7 projects with them. We've already exited 4 of them, and we're working on 2 more. So that's an indication of a good relationship. They value what we're doing. We bring a lot of value to the table for what because we're able to raise a lot of our capital very quickly because the terms are good. The developer doesn't have to spend a lot of time dealing with the capital raising himself. So he essentially brings it to us. We're usually the single check into the project, which is kind of nice. So he doesn't have to deal with all these different people, each writing some check in. So in a lot of our projects, we are the majority or the single check that goes in. Um, and then the remaining is maybe even just GP equity that is put in by the developer. So we try to make it very easy, and so there's value to it because then they can focus on continually building up and building more developments and stuff like that. We continue to kind of be that finance
So
seer.
there is no bank usually in your deals.
No, there is a bank, but as you probably know, most banks only leverage up to maybe
Right.
65,
Gotcha.
70%. So we're that gap. We usually bring it all the way up to around 90%.
Great. Okay. Well, very good. Well, so yeah, that's a different side of the business that a lot of people don't see. And I think that you have a great background to be able to bring in capital, obviously, from the things you've done and done it so quick. You're still young, right?
I think I look younger than I am. But
Well,
yeah.
well, you graduated in '08 though, right?
Yeah,
So
I am in my late 30s, so I'm about to hit my middle age.
I guess, yeah, I guess my math isn't so time flies. In any case, so is there a pivotal person or event that brought you to where you are today, or that's pushing you forward to where you want to be?
Yeah, I mentioned that we work exclusively with a sponsor, so they're really kind of the ones that bring in a lot of the deal flow, and we work a lot on bringing in the capital to support those deal flow. But we met at the conference. It was actually an old capital conference here in Dallas. Um, what I have found is that conferences are great places to find new partners. They were just sitting in the corner, and I just approached them, walked up to them, and since then we have worked on. I think we've done about 8 deals together. So we've done a lot of projects together, and we foresee doing more going forward. So I would say a lot of people, I mean, early on, myself included, I try to find investors at conferences and all. And I have, but I would say most of the time, for me to build my Rolodex of investors, I have actually found most of them online and all, through LinkedIn and other channels. But conferences have been ways for me to solidify and put a face to it. So many times when I've been to conferences is actually with people who have invested with me, but we've never actually met in person. We may have met over Zoom, and then now I'm like, hey, here I am. But I think that's been a pivotal point, was having this great relationship with this partner, and that came about by simply a taking the initiative and walking up and saying hi to them.
Pivotal partner. Okay. And do you want to name them? Because like I said,
Yeah, yeah.
okay.
It's Astor Realty Capital. The principal is Joe Burkle. They are a fantastic group to work with and obviously invest with as well.
Right. So we'll work out if you're going to let them know, or if we will, and
Hmm.
try to get them on the show, and they get a pin that says pivotal person and all that too. So yes,
Awesome.
that's yeah, it's fun. It is. It's remarkable when if you wear it at the events and all. Yeah, it is. It's
Hmm.
good.
Yeah.
But fantastic. Okay. Well, so repeat again, if you would, how people can get in touch with you.
Yeah, the best way to get in touch with me is via email. My email is Kevin at Cornum, CORNUM, cap.com. So just send me an email. It's love to talk. Anyone new, experienced. This again, it's all about just building relationships. And if I can answer questions about what I do or about the structures, and all, then let me know.
One other thing we didn't say after we started recording, I don't think, is what size check you like to write.
I would say we typically start at checks around like 5 million, and we're doing deploying checks up to around 20 to 30 million. So it really kind of depends what it is. But right now we are working on 3 projects totaling between the three, somewhere around, let me see, almost 45 million between the three. So average about 15 million of them.
Some pretty cool stuff. All right. Well, very good. Well, we will put all the show notes down so that people can find you as well. And so you should be aired here in the next few weeks, probably. But thank you very much for coming on. Really appreciate it.
Thank you. Thank you for the opportunity.